Imagine waking up to see your entire portfolio in red. Not just down 1% or 2%, we're talking major drops across every sector. Headlines screaming panic, investors fleeing, and while most are watching their net worth shrink by the second, a small group is quietly preparing to get rich, because when markets crash, fortunes are made, not lost. But only if you know what to do next. Today we're diving into what could be the biggest opportunity of the decade. I'll explain why the stock market is crashing, how deep it could go, what the recent tariffs really mean, and which stocks might surge when the dust settles. You'll also learn the biggest mistakes to avoid when the market tanks, so you don't get burned when others panic. And if you find value in this video, take a second to hit that subscribe button and join us here at Money Quest Broker, where we turn chaos into opportunity. Let's get started. The U.S. stock market just had one of its worst days since the early days of the pandemic. Major indices like the S&P 500 and NASDAQ dropped sharply following the announcement of sweeping new tariffs. These aren't just minor adjustments. They're massive reciprocal tariffs affecting nearly every trading partner of the U.S., with rates far beyond what markets expected. For example, imports from China now carry a combined 34% tariff, on top of the existing 20%. The EU, 20% tariffs, and Southeast Asian nations like Vietnam and Cambodia have been hit with staggering 46% to 49% rates. That's a big deal considering how much the U.S. imports from those regions, especially electronics, machinery, textiles, and raw materials. So what's really going on? This isn't just about trade, it's part of a much broader economic strategy. There's a three-part plan in motion here. 1. Use tariffs as leverage to renegotiate trade deals. 2. Enforce so-called reciprocal tariffs to level the playing field. 3. Devalue the US dollar strategically without hurting its global dominance. Sounds clever, right? In theory, this should help American manufacturers and workers compete better. But here's the issue. These reciprocal tariffs, they're not actually reciprocal. These tariffs are based on a simple formula, not the actual rates other countries charge. They take the US trade deficit with a country, divide it by how much we import from them, and then cut that number in half. That's the new tariff rate. Take China as an example. Trade deficit in 2024, $295.4 billion. U.S. imports from China, $439 billion. 295.4 divided by 439 equals 67.3%. Divide that by 2, and you get 34%. But it gets worse. Some countries actually buy more from the U.S. than we buy from them, yet still got slapped with a 10% tariff. That includes 115 countries with trade surpluses in our favor. This has created chaos because there's no clear way for other countries to respond reciprocally. And now we're already seeing retaliation. China announced 34% tariffs on U.S. goods. More countries are likely to follow. When exports fall, U.S. company sales drop, earnings shrink, and stock prices follow. That's how these tariffs tie directly into the ongoing market crash. Let's look at history. According to First Trust and Bloomberg, bull markets last an average of 4.3 years with 150% total returns. Bear markets last about 11 months and typically fall around 32%. And here's the kicker. Bull markets are 4.5 times longer and generate 3 times more gains than bear markets lose. Even better, the recovery always comes. In 1956, the market fell 21% in 15 months and took 11 months to recover. In 2020, it fell 34% in 1 month and rebounded in 5. The takeaway? Crashes are short, recoveries are longer, and they're where the money's made. So how do we know when it's time to be greedy? I always start with CNN's Fear and Greed Index. Right now it shows extreme fear, one of the lowest levels in the past 1 year. This index pulls together 7 key indicators: market momentum, price strength, volatility via the VIX, put-call ratios, and more. 2 of my favorites? Momentum. I track the S&P 500 versus its 125-day average. If it's below and falling, I build cash. When it flattens or rises, I start buying. The VIX, a forward-looking volatility index. When it spikes and then stabilizes, that's usually a sign the panic is fading. Now before we talk stocks, let's get real. Most people don't lose money in a crash because of bad picks. They lose it because of bad behavior. Here are the top mistakes to avoid. 1. Panic selling. Selling at the bottom locks in losses. Just ask anyone who sold in March 2020 and missed the rebound. Be patient. 2. Going all in too early. Crashes happen in waves. Don't blow all your cash on the first drop. Scale in slowly as the market stabilizes. 3. Chasing speculative stocks. A cheap stock isn't always a good one. Focus on companies with real earnings and strong fundamentals, not just hype. 4. Ignoring diversification. Spreading your bets across industries and asset types protects you when one sector tanks. 5. Trying to time the bottom. Nobody times it perfectly. It's better to be roughly right than exactly wrong. Watch for reversal signs and move in gradually. Let's get to the good stuff. These are stocks I believe are positioned to bounce back big once the dust clears. 1. Google or Alphabet. Trading at a PE of 18, the second lowest in a decade. DCF models show it's 43% undervalued. Potential upside? 77%. This is a rare discount on one of the world's most profitable advertising engines. 2. Meta platforms. Fair value models peg it around $880 per share, 43% undervalued. Actual earnings growth has been over double analyst estimates. If you believe digital ad revenue will rebound, this is a strong pick. 3. Taiwan Semiconductor, or TSMC, makes 90% of the world's advanced chips. Think Apple, Nvidia, Tesla, trading around $150 with fair value closer to $225. That's a 50% potential upside. Yes, tariffs could hurt, but this looks more like leverage to get TSMC building in the US. 4. Nvidia. PE ratio of 32, lowest since 2019, 20% undervalued even using conservative models. With AI demand exploding, I personally think the long-term upside is much greater. So let's recap. We covered why the stock market is crashing, how tariffs are driving the downturn, what history tells us about how long it could last, when to be fearful, when to be greedy, what not to do, and which stocks I'm watching right now. If you got value from this breakdown, subscribe to MoneyQuest Broker so you don't miss the next move. Because the best way to get rich is to stay ready when opportunity hits. Thanks for watching. Stay smart, stay patient. And remember, market crashes are temporary, but smart decisions last forever.